Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 21st of January. I'm Daniel Lam, your host for the podcast. Towards the end of last year, in Singapore, a Chinese player and an Indian player contested for the World Chess Championship, ending in a victory for the Indian player, Gukesh. Now, we also know that Chinese and Indian equities often compete for fund inflows, especially amongst emerging market funds. Now, in the last podcast, we spoke about the near-term challenges for Indian equities. So how are things looking for Chinese ones? Well, the Hang Seng Index has staged some encouraging price action over the last 6 to 7 sessions, gradually recovering after dipping below the 19,000 level. It seems to be challenging the first resistance of 20,500. No doubt, the recent conversation between President Trump and Xi, as well as Trump's wish to visit China in the near future, raises hopes that the trade war may not be as severe as what have been priced into Chinese equities. The recent Chinese data released last week has also been reasonable. Real GDP growth picked up to 5.4% year over year in the fourth quarter of 2024, beating market consensus of 5%. Seasonally adjusted GDP expanded by 1.6% quarter-on-quarter in Q4, up from a revised 1.3% in the third quarter. And that partially reflects the impact of the stimulus package. As a result, the annual GDP growth came in at 5% for 2024, achieving the government target. Industrial production growth edged up to an 8-month high at 6.2% year over year. In addition, services production index growth edged up to a year-to-date high of 6.5% year over year. In addition, growth in infrastructure investment and retail sales of consumer goods accelerated in December, partly reflecting the policy effect. Now, we believe news flow and headlines from the tariffs can influence Chinese equities very abruptly, in both directions, in fact, in 2025. Therefore, we continue to advocate a barbell approach for Chinese equities. In our opportunistic ideas, we want, first of all, consistency and steadiness. Therefore, we favor high dividend yielding non-financial SOEs. And we also want exposure to the consumption plays reflected in our opportunistic idea in the Hang Seng Technology Index, where they may benefit from stimulatory policies and any warming up of Trump's news. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.